Hi there, welcome to an emergency video. And the reason why I'm calling this an emergency video is because I had no plans to do this video today. I had this other video all lined up, prepared, ready to be released on AI media. So if you do want to hear about me talking about AI media in their interesting half-year report, you're gonna have to wait till tomorrow. Anyway, the main reason I decided to do this emergency video, apart from the markets down big today, XJO down 3%, and NASDAQ, the NDX, which is the NASDAQ 100, was down 2.6%. Those are sort of effects of some other things that are happening in the world right now. In particular, Russia invading Ukraine. Not sure if that's completely official now, but I was watching a news broadcast from Kiev. In fact, I'm not sure if it's Kiev or Kiev. I've always pronounced it Kiev, but I did hear a news presenter today pronounce it Kiev. Anyway, it's also spelled K-Y-I-V. I always spelled it K-I-E-V. So I'm not sure who's wrong or that was how you spelled it in the past and they've just changed it. Anyway, so Russia invading Ukraine and the markets are down. And the reason why this sort of thing would lead to markets down is all about uncertainty. It's all about risks. And people don't like war, particularly because it increases uncertainty. And right now, no one knows what's going to happen over the next few days, next few weeks, even potentially the next few months with Russia invading Ukraine. And there are certain sectors that will benefit from this, in particular gold and oil, which we did see spike today. And I do have some gold and oil in my portfolio. And sometimes when the perceived risk of Russia invading Ukraine was lower, we did see the markets go higher, and my portfolio wasn't performing as well simply because gold and oil stocks weren't performing during those days. But on a day like this, even though the overall market was down 3%, my portfolio was nowhere near down that much because I have diversified my risk. And these other times you want to do that. And some people will say you need to be fully invested all the time because you can't time the market, you can't time the tops, you can't time the bottoms, but you can mitigate your risk. I do believe you can't perfectly time the market, but you can mitigate your risk. And by mitigating your risk, one of the things you can do is go a little bit more into cash, particularly if we are seeing the markets turning around, which is potentially what we're seeing right now. So maybe I'm ranting on a little bit, but those factors, particularly Russia invading Ukraine, were the catalyst for me doing this emergency video today. So what I'm going to do is look at some of the indices, including the NASDAQ, S&P 500, Dow Jones, XJO, XSO. We're also going to look at the FTSE 100, which is a really interesting chart. And all these other charts, indices, are looking fairly bearish right now, and really FTSE 100 is not looking bearish at all. And that could be changing as we speak. In fact, the English markets will be opening up soon. The other thing I'm going to look at is gold and oil. So I've already talked about them, how sometimes certain sectors will benefit from these sort of situations. But you also have to be wary that if instead of this situation accelerating or getting worse, it could be nothing. It could maybe Putin would decide, well, he doesn't want to get into too much trouble and he'll withdraw his troops. And then everything that was simmering up, just nothing happens. And if that's sort of the case, we might see gold and I'll pull back a fair bit from here. So let's get stuck into it and look at some of the indices that I do follow. And then we'll look at gold and US oil. Let's start with the NASDAQ, and this is looking very bearish. Now, I just did a State of the Markets video not long ago, a few days ago. Things have changed a little bit, and this is actually looking at the NASDAQ, which is the NDQ, the top 100 companies on the NASDAQ. It's looking actually a lot more bearish. If we actually focused on the NASDAQ composite, which is IXIC, it's actually looking way more bearish than this. Anyway, if we go back before the start of this year, the NASDAQ and most markets around the world were in uptrends. And the particular feature about the uptrend was buy the dip. So we saw buy the dip back in March, here it is, another buy the dip in May, another buy the dip in September. And any time the market got towards or in between the 100-day and 50-day moving average was buy the dip situation. On all those occasions, for a brief period of time, the NASDAQ fell below the 100-day moving average, and that was the time to buy the dip. Now, the next buy the dip completely failed, which was towards December. We had a couple of buy the dips opportunity, but we didn't see the market pull forward. So after buy the dip opportunities, you should see the market reach new highs, and we didn't see that in December, and then we saw the markets or the NASDAQ collapse in January. Really interesting, once you got to the end of January, just zoom in here, we see 5 days where the NASDAQ just went sideways and some good tails on the candlesticks here. These are the tails here. And that means there's a lot of buying coming in, because that would have been a nice little support level. And the way to draw this support here, there it is, nice little support level there. The reason I'm calling that support level is that was a high back in April, and then when you go to June, it struggled. NASDAQ really struggled to get past that high, and that was a natural support level for the NASDAQ around that point in time. And then a few days ago, we went straight through that support level on fairly good strength, and then we had this large 2.6% down day. And right now, we're in this period, you can see between about February and April of last year and May last year, even though the market was still going up at that point in time, it was really struggling. So you can see a lot of days, I won't say range trading, but there's a lot of days in between about 12,400 and 14,000. So it took a bit of time to get out of that range, and when it did, it went a bit higher. So in between about 12,400 and 14,000, I think that is a good support level. And if we go through that on strength, that would be a fairly bearish move. And then we have to go back all the way to right here, and I'll just draw another. Draw in another line here, so that would be the next support level if this support region or zone fails. And the reason I'm calling this a support level is you can see back in September and October last year, that was the level the NASDAQ struggled to get above. You can see it reached it in early September, pulled back into a buy the dip opportunity, reached it again in October, pulled back, another buy the dip opportunity, reached it again in early November, pulled back, didn't quite get into buy the dip opportunity, and then zoomed past it towards the end of November. So that was a fairly good, strong resistance level. We tested, or the NASDAQ tested it twice just after it pulled through. You can see a little test here. See, that's a test right there, and it tested again in March, and both of those tests succeeded. And what I mean by succeeded means it didn't go below. The market didn't go below that support level, which was a resistance level back here. So that's the next support level for the NASDAQ. And if we get to that level, who knows what the next support level would be after that. I haven't looked that far ahead. So that's the NASDAQ. It does look really bearish right now. The trend is down. Sentiment's fairly weak with the NASDAQ. We did see the NASDAQ did climb, a little bit of a dead cat bounce, not a lot of strength in that dead cat bounce. And that's the whole definition of a dead cat bounce. There's not a lot of conviction as the NASDAQ rose. So even though people like Cathie Wood are thinking there's deep value in all her companies, she's got it in her funds, that's not absolutely true. Most of her companies are not profitable. They might be profitable in 10, 20 years, but at this point in time, those sort of companies are not in favor. It might change fairly rapidly, but who knows, it could take a few years before that changes. Now let's have a look at the Dow Jones, which I don't usually look at, just simply because it's a fairly old indice. Anyway, so this is actually looking really interesting as well. And recently, we have seen a crossover in the moving averages. And right now, at the end of trading on whatever day it is, don't even know the dates, 23rd, 24th of February, the NASDAQ is looking at a really interesting point. So right now, if we draw a bit of right here, so that is a support level with the Dow Jones. So anywhere in that, the reason I call that support level, you can see back in March of last year, it struggled to get above that level, then it got above it, and then it tested it back in June, and then has been going higher ever since. There was another nice little support level here around this level, and you can see the Dow Jones test this level on 5 occasions. 1, 2, 3, 4, 5. And then if we zoom in here, it tested this support level on 5 different occasions. Actually, not different occasions, 5 consecutive days in early February. You can see on these candlesticks really large tails, and that means there's a lot of buying coming in because the Dow Jones went below that support level and people got a little bit excited, and that's why they bought in, and that excitement lasted the next 4 days, and you can just see the Dow Jones rise. A lot of people thought that was it. This was the end of this little short-term correction. In fact, I even I was listening to Motley Fool, and that was their theme, that this little correction had come to a completion. Now was the time to buy more shares, that sort of thing. Probably putting words in their mouth. But anyway, the NASDAQ fell through, the Dow Jones fell through that support level quite easily, and it's gone to another support level and is right on that support level right now. Might have even dipped below it, but we'll have to wait for the next few trading days. Wouldn't surprise me to see the Dow Jones down again a lot today because of the confirmation of Russia invading Ukraine. But a lot of times in war, it's when the war is confirmed that can be a signal of the bottom, because for funny reasons, a lot of investors or the markets are really nervous about the potential possibility of war, and then when it's confirmed, they go, well, that's it. Risk is over. We know what's happening now. Now I'm going to start buying. So this is potentially the bottom of the markets right now. Now let's have a look at the S&P 500, very similar to the Dow Jones, right on a good support level. There it is, nice support level. If we go back here, the reason I drew that line as a support level is it really struggled to get above, what's that, 42.25 or something like that in May and June of last year. Got above it and then tested again like a month later, and then kept on rising. And it just like the Dow Jones, there was another support level just above that, and you can see just like the Dow Jones, the S&P 500, we had these 5 days with these long candlesticks. Like the bottom tail was very long. That tells us there's a lot of buying, and we've gone down past that, and we're at another support level right now. If we move further below that, in fact, the S&P 500 is just below that support level. So if we have another big down day on trading tonight, that could be confirmation that that support level has failed. We might test it again, but there is that possibility again, as I mentioned previous, that sometimes the confirmation of war could be the bottom of the markets. We'll have to wait and see. Now let's have a look at some of the Australian markets. First up here is the XJO. So I have 2 sloping orange lines. This is the long-term trend. So no worries there with the long-term trend. We're right in the middle at the moment. Funny enough, the Australian markets really overreacted towards the end of January. You can see we had 4 big down days, and the XJO fell from about 73.50 all the way down to a low of 76.60. I'm not sure why the Australian markets reacted in a more major way than a lot of the overseas market, and then our bounce, our little recovery, was way more impressive than other markets as well. You can see it almost recovered all the way back, not quite. There was one day where we actually recovered all the way back, but there were 2 days here with long tails to the upside. You can see there was this one day here, which was the 10th of February, and on the 17th of February, we had the same thing. We had an up day, and then there's a lot of selling came in during the day. That's why you get these candlesticks with these long tails to the up, just a lot of selling. And that reason we had a lot of selling is the market participants had seen, and the XJO got to a support level or a resistance level, and that resistance level is these moving averages and the previous high before we saw these big down days, and that's why we saw the selling. And the XJO has pulled back since then, another big down day, but we have not got as low as the previous low back in late January, so not as bearish as the NASDAQ. If you go back to the NASDAQ, for comparison's sake here, the NASDAQ has gone well below those previous highs in late January. And I think the difference is the Australian market's just overreacted back in late January for some reason. I don't know. But this is still looking fairly bearish. Not sure how much lower this has to go. Now, the XSO, which is the small caps, that's looking a little bit more bearish, which is understandable because small cap companies will react more fiercely in these sort of situations. They're the first to react, and their reaction is going to be more severe than the bigger companies like the Woolworths and Wesfarmers and the banks. Those companies won't fall as much as a lot of small cap companies will fall. So this is looking a little bit more bearish, and right now it's at a support level. The reason I'm calling that support level, again, I'll have to draw this line here, is it's right at the level at this low back in May of last year. Even though we did pull through it quite strongly in late January, the recovery back past that support level was quite strong. So I'm going to sort of ignore these 2 trading days just in there, just because of that pretty intense price action over those two trading days on the 27th and 28th of January. So again, looking really interesting right now with the XSO. Now let's have a look at the FTSE 100, which I've got to find here. Here it is, the FTSE 100. This is still technically in an uptrend. Right now, in fact, I'd say this is buy the dip in the FTSE 100. So if you do have an account that can take advantage of companies on the FTSE 100, maybe now is a time to buy the dip. The only problem is potential with this potential war in Ukraine. We have a little bit more to fall, particularly if they react to the American markets down big. We could see another big down day on the FTSE. But it's really interesting that even though the other markets are looking really bearish right now, the FTSE 100, the UK markets are not looking anywhere near as bearish. Same can be said for the German markets. It hadn't been looking as bearish. In fact, the DAX was going sideways, but looking much more bearish right now. In fact, the previous high, or the previous low, or the last time we were this low, or the DAX was this low, was way back in March. And when you look at the other indices, their previous low, or the last time it was this low, was like May, June last year. So in fact, the DAX is at almost a 1 year low right now. So I thought the DAX wasn't looking as bearish, but actually is when you look at this chart right now. Let's have a look at Bitcoin and Ethereum. So we've got a couple of, this is the long-term trend, or this was a long-term trend, which was broken. So I'm just going to get rid of that. We'll get rid of that. Delete. This was a support level that was broken as well. So we'll get rid of that. Anyway, if we look at the Bitcoin, really over the past year, it's just been volatile. It's been going up and down, no trend right now. We'll say long-term, well, medium to, yeah, we'll say sort of in between medium, long-term trend right now, because it's been going sideways. Short-term trend definitely is down with Bitcoin. We do have a crossover. We did have a crossover between the 50 and 100, but we've had a few crossovers over the past year. But right now is a nice little support level with Bitcoin. The reason that's a support level is just because that's the recent low. And when we got to that recent low, there was a bit of buying with Bitcoin. You can see those long tails. It's all about tails. I always love to look at tails. If you have large tails or long tails to the bottom, that means there's a lot of buying. If you have long tails to the top, that means a lot of selling. And as you can see here on this day, which was 4th of December 2021, Bitcoin at one point was down massive. But you can see this long tail, long tail, a lot of buying, and that was telling us there was a bit of strength. But I think that was false strength because Bitcoin has gone lower from there. That was just buy the dip. Investors, if you call people who buy Bitcoin as investors, I still believe Bitcoin, Ethereum, cryptocurrencies is all about speculating. It's not investing. Anyway, so a really interesting point for Bitcoin right now because we're right at that previous low. If you go through that low, that would be a bearish move. And then the next really interesting low would be right on almost 30,000. Now, round numbers is very important when it comes to investors. They love round numbers for some reason. And 30,000 is a particularly powerful round number. And if we go back to May, July last year, 30,000 was a very important level for Bitcoin. In fact, you can see it on 3 occasions leading up to July last year. Bitcoin got to 30,000. A lot of buying came in. Again, you can see these long tails. A lot of buying, buy the dip sort of investors, speculators. And then right on around about 21st of July, it hit 30,000, and then we saw a little bit of a bull run. And that was confirmation that that support level held. It tested it, and then it pulled back. I'm not sure why. There was a lot of buying at that point in time. Who knows when it comes to Bitcoin and Ethereum. But if we get to that level and fall through that level, that will be a massive, massive bear signal for Bitcoin. And Ethereum is looking even worse right now. Or maybe not worse. Actually very similar signals here than Bitcoin. In fact, when you look at it, so right now it's at a very strong support level. Not strong, slight support level, because it's got to that previous low, and then that lows that we did see in Bitcoin last year around May to July. That's at what's that at 1800 for Ethereum. If we go below that, that will be a fairly bearish move for Ethereum. Now, I do not have any cryptocurrencies now in my portfolio at all. I just like looking at the charts, because you just don't know what's going to happen in the future. And if I do see a fairly bullish move with any sort of cryptocurrency, I might take advantage of that. It would not be an investment. It would just be a speculation, because I don't know what the long-term future of these cryptocurrencies is. It could be anything. It could be massive, or it could completely fail. Just don't know. Now let's have a look at US oil and gold. We'll start with US oil, and this is really bullish. This has been on a bull run for quite a while. In fact, I'd call this a bull run since about November of last year, when the price was $40 a barrel. And this has been definitely buy the dip opportunities here. You might be getting a little bit freaked out when the US oil would fall significantly below the 100-day moving average, but then a lot of strength comes in. And right now, the whole reason why US oil is going on a bit of a run is because of what's happening in Ukraine and Russia. The reason the market's concerned about this potential war, if I can call it a potential war in Ukraine and Russia, is the effect it's going to have on oil. And one of the biggest problems about high oil prices is the effect that has on inflation. If we see sustainable, large, high oil prices, that will have a significant impact on inflation. And even those expectations, those people who believe inflation will fall to 2 to 3% in the next year, and there's a lot of experts who believe inflation will fall significantly in the next year. If we see continued high oil, those sort of ranges in inflation will be nowhere near it, because oil and high prices of oil have significant impacts on prices all around the world. Now, you can take advantage of that and buy some oil companies, but you have to be aware, because right now the oil price is at $97. The last time it was this high, let's have a look. The last time it was this high was back in 2014. So right now at an 8-year high when it comes to oil. You can see back between 2011 and 2014, oil prices were quite high, not quite as high as 2008 when they got to $150 a barrel. So you have to be aware. Just be aware that right now the prices are going up mainly because of geopolitical tensions in Russia and Ukraine. Now, last stock is gold, near the top, just below the American indices, and this has definitely broken out right now. So we are at multi-year high, and when I say multi-year high, I'm talking about 1 year and 2 months. Last time gold was this high was back in November of 2020, and if gold gets above this high right here, I'll put a little line there. So if gold gets above that line, which is 2067, that would be a very bullish move with gold. So gold has been going sideways since then. Now, even though it does look fairly choppy, it has been going sideways. Maybe consolidation would be a good way to put it. And if we do go above that old high back in August of last year, that would be a bullish move. And right now, it's heading towards that way. I don't want to say it would definitely get there, but again, gold is benefiting from what's happening in Ukraine right now. And if these tensions keep on going, or if it explodes into a larger conflict with multi-players on both sides, who knows where oil and gold could end up. That's all for this emergency video. The XJO down 3%. Now, to be fair, I think it was down 2.99%, so not quite 3%. and the NASDAQ down 2.6%. As I mentioned during this video, this could be it. This could be the low, because in wars in the past, the moment that war is confirmed, that has been the bottom. That doesn't mean this will be the bottom. This could be a more significant conflict, or it could be just nothing. Maybe this time tomorrow, Putin has, opened his eyes up to how this is going to be bad for him, the world, and he'll withdraw his troops. That's a possibility, but who knows? This could be the beginning of World War III. We just don't know right now. I think that scenario is fairly low, but you just can't rule out those sort of things. And when it comes to investing, what I usually do when the market is down 3% is I just stay clear. I don't do any buying, don't do any selling, and I wait for a little bit more clarity when it comes to the situation. But I have gone to cash over the past few months, added to my cash pile, and if we do see a significant decrease in the markets over the next few months, 6 months, even a year, I do have a stockpile of cash to take advantage of that. If you do have any questions about anything I've talked about in this video, just leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.